and welcome to Askimo TV. Today we're joined by Jonathan Lea, who is a commercial lawyer and tech startup advisor. Jonathan, can you tell us a little bit about how to incorporate a company and what it does?
Yeah, hi Lisa. Sure, incorporating a company these days, particularly in the UK, is pretty straightforward. You can go on any number of online websites, and in a couple of hours you can insert the relevant details, and hey presto, you've registered a company, and you'll appear on the public company register. Principally, to the details you just need to give are the individuals who are going to be, or the individual singular who's going to be the director, or directors, perhaps also a company secretary, although that's not obligatory anymore. And then also who the shareholders are going to be. And usually when you incorporate a company, that's one and the same person. The one shareholder, two shareholders are also going to be the directors who manage the company on a day-to-day basis. And then you get the basic details, confirming the date of registration and a certificate of incorporation back from, in the UK, what's called Companies House, which is the public register. You also need a set of articles of association, which is the company's public constitution. But normally people just register the company in the first instance with a standard set of articles that just works in coordination with the main company law, which is in Companies Act 2006. If you want to sort of bespoke your kind of constitution, as it were, or how the shareholders make decisions, then quite commonly people will just do that through an additional shareholders agreement, which is a private document and doesn't have to go on the public register, but just outlines how the shareholders make decisions and how the company is run and how the ownership is structured as well. Which will give a bit more clarity than just relying on standard provisions in the articles and through company law.
Mm-hmm. And so what are the advantages? Are there any tax or business advantages to incorporating a company?
Yeah, I mean, the main disadvantage really is that there's a little bit more admin involved and paperwork, but again, with the fact that everything works online now, that's a lot more straightforward than it used to be. For example, filing your accounts and your annual return, and whether you want to change a director or whatever change you want to make, you can just do in a few seconds through the Companies House website. Whereas I remember a few years ago that was a lot more complicated, having to actually do the paperwork, send it off, get people to sign physically, then get confirmation from Companies House, etc., etc. So I've gone off message a bit. What was the original question you asked us now?
I was just asking if there are any tax advantages or business advantages, particularly.
The tax advantages. If you actually make money, if you make profits, then you can. The shareholders can pay themselves dividends as well as salaries, and the dividends attract a lower rate of income tax than you would do if you just paid yourself a salary, which in the UK particularly gets quite high. If you're making a lot of money, gets a high rate of it's now currently 50%, so massively high rate of tax on money you make. In addition, you have to if you're just paying yourself salary, you've got national insurance contributions, which the state deducts, and also PAYE, so which is a bit of an administrative headache. So it's a bit more straightforward and more tax efficient to pay yourself dividends, if of course you make enough money to if you have sufficient distributable reserves in the company to be able to do that. Of course, you can't be too blatant, otherwise the various sort of nuanced rules, but getting the balance right between dividends and salary, so that you don't upset revenue and customs too much. But of course, like anything, speak to a good lawyer or tax advisor or accountant or whoever it might be. But also it gives, other than, there are other tax advantages as well, and being able to manage offset, being able to use the company as a sort of separate entity, as it were, to, for example, offset expenses and things, and you've got the limited liability of the company, so your personal assets are secure. The liability is limited to only what the share capital of the company is, and also still it presentational purposes. It gives outsiders or people you deal with or contract with, I guess a better impression if you're trading as a limited liability company rather than just as a sole trader or partnership, which in these days looks a little bit amateurish, even though by doing that you're just putting everything on, all your personal assets on the line. So in some ways you could argue that people would want to trust you more, but generally that's not the case.
Okay, Jonathan. Well, thank you very much for your time today. Thank you.
Okay, thanks very much.